In the late 1990s, Enron Corporation stood as an emblem of corporate success and innovation. Founded in 1985 by Kenneth Lay, it transformed from a humble natural gas supplier into one of the world's largest energy and commodities trading companies. Under the leadership of charismatic CEO Jeff Skilling, Enron was hailed as a pioneer in the energy sector, shaping the future of the industry. Enron's meteoric rise was characterized by an intricate web of financial maneuvers. They pioneered the use of mark-to-market accounting, which allowed them to book potential future profits immediately. This accounting wizardry made their balance sheets appear incredibly robust, and Wall Street rewarded them with soaring stock prices. Enron became a darling of investors, and its stock was a must-have in portfolios. Behind the scenes, Enron was engaged in a web of shadowy deals and partnerships that obscured their true financial health. One of the most infamous entities was LJM, a partnership founded and controlled by Enron's CFO, Andrew Fastow. LJM was used to hide Enron's debt and move poorly performing assets off the books. Meanwhile, Skilling and his team encouraged employees to buy Enron stock while they secretly sold their own shares. Employees were led to believe that Enron was infallible, and many invested their life savings in the company's stock. The cracks in Enron's facade began to show when Sharon Watkins, a mid-level executive, couldn't ignore the irregularities any longer. She penned a now infamous memo to CEO Kenneth Lay, warning of potential accounting problems and suggesting a thorough investigation. Watkins's memo, dated August 2001, became a turning point in Enron's history. As the truth started to unravel, Enron's stock price went into freefall. Credit agencies downgraded the company's debt, and investors began to panic. Employees watched in shock as their retirement savings evaporated. In October 2001, Enron reported massive losses and announced a $1.2 billion reduction in shareholder equity. The once mighty corporation was spiraling towards bankruptcy. Lay and Skilling resigned under mounting pressure, and Enron filed for Chapter 11 bankruptcy protection on December 2, 2001. The collapse of Enron sent shockwaves through the financial world, resulting in regulatory reforms and increased scrutiny of corporate accounting practices. Thousands of employees lost their jobs, and many saw their retirement savings wiped out. Shareholders filed lawsuits against the company, its executives, and its auditors, Arthur Andersen. Arthur Andersen, one of the Big Five accounting firms, found itself under intense scrutiny for its role in the Enron scandal. The firm's questionable accounting practices and shredding of documents further eroded public trust. In the years that followed, legal proceedings unfolded. Skilling, Lay, and other top executives were indicted and convicted on charges of fraud, conspiracy, and insider trading. Arthur Andersen was also found guilty of obstruction of justice, leading to its demise as a major accounting firm. The Enron scandal prompted significant reforms in corporate governance, accounting standards, and financial reporting. The Sarbanes-Oxley Act, passed in 2002, introduced strict regulations to improve transparency, corporate accountability, and the integrity of financial reporting. The Enron scandal serves as a cautionary tale of corporate greed, unchecked ambition, and the consequences of unethical behavior. It revealed the dangers of complex financial schemes and the importance of transparency and accountability in corporate culture. As the years passed, Enron became a symbol of corporate fraud and hubris. It serves as a stark reminder that even the most powerful corporations can collapse when built on a foundation of deceit. The legacy of Enron continues to influence corporate governance and ethical practices, ensuring that its story is not forgotten in the annals of corporate history.